Hey everyone, welcome back. It's time for another deep dive into the market. Today we're going to be looking at the Dow, the S&P 500, and the Nasdaq. You want to know how President Trump's policies are affecting things? Right.
Absolutely. It's a question on everyone's mind. We'll be digging into a financial news article from January 22nd, 2025.
It's got all the latest details. Some pretty surprising company performance news, too.
Like Netflix, they just blew past subscriber expectations. And there's that potential $500 billion AI infrastructure investment.
Yeah, that one's got everyone buzzing. So let's dive in.
What's interesting to me is that despite all the political uncertainty, especially around President Trump's trade policies, the markets are reacting pretty positively.
Right, they're up. It's a mix of strong economic data and some really interesting company earnings reports.
Exactly. A lot to unpack there.
Okay, so let's start with the big picture. The article highlights the Dow, the S&P 500, and the Nasdaq all showing gains. But the S&P 500 is the real standout here. It's sitting above 6,000 points, getting close to those all-time highs again. It's quite a turnaround from all the anxiety investors were feeling just a while ago.
Yeah. Remember all that talk about tariffs on imports from Mexico, Canada, China?
Oh, yeah. Initially, there was a lot of concern about those tariffs escalating into a full-blown trade war and what that would mean for the global economy.
A lot of people were worried for sure. But it seems like the market's taking a more, a more measured view now.
It does seem that way. Investors now see President Trump's approach to tariffs as more strategic, less about protectionism, more like a negotiating tactic.
Okay, so less trade war and more strategic negotiation. Got it. But it's not just easing trade tensions driving this market positivity. The article mentions strong economic data, too.
Oh, absolutely. The data is really pointing to a healthy economic environment. We're seeing solid growth, coupled with cooling inflation. It's the perfect scenario for businesses and markets. When inflation's under control, businesses can plan for the future with more certainty.
Right.
That encourages investment and growth.
Makes sense. Now, there's also all this talk about Treasury bond yields and how they influence the risk-taking mood on Wall Street. I gotta admit, the bond market is a bit of a mystery to me sometimes.
I can see why. It's a little more nuanced than watching stock prices go up and down. Basically, when bond yields are low, like they are now, particularly the 10-year Treasury note investors seeking those higher returns tend to shift their focus to the stock market.
Okay.
That influx of capital then pushes stock prices up, fueling the kind of growth we're seeing.
So lower bond yields make stocks more attractive, which drives prices up. It's all interconnected.
Exactly.
Speaking of attractive investments, let's talk Netflix. Their stock is through the roof today, up over 15%. They just crushed subscriber expectations.
They reported a massive 301.63 million subscribers.
Wow.
Way past the projected 290.9 million. The market's definitely reacting.
It shows how crucial subscriber growth is for a streaming company like Netflix.
Right. It's all about attracting and keeping those viewers in this streaming war.
Yeah.
And Netflix is clearly winning.
But it's not just subscriber numbers, is it? Their overall financial performance is incredibly strong.
For sure. They've exceeded earnings and revenue projections, which is always a great sign. It means their business model is working. They're making money from their subscribers. And get this. They're projecting even higher revenue for 2025.
How much higher?
Between $43.5 billion and $44.5 billion.
Whoa, that's almost $500 million more than their previous forecast. Netflix is on fire?
It's not just about spending money on content, though. There's a real strategy here.
Like what?
Understanding the global market. Investing in diverse content that resonates with different audiences.
Right.
And constantly innovating their platform. They're not just keeping up with the competition, they're setting the pace.
That's awesome. Now let's talk about Oracle and AI. Their stock is up 10.2%.
Big jump.
Thanks to President Trump's surprise announcement of that huge investment in AI infrastructure.
A game changer. We're talking $500 billion.
Yeah.
It's massive for the AI industry. And it's not just the government throwing money at it. This is a strategic partnership, a joint venture called Stargate.
Okay.
With OpenAI and SoftBank as partners.
Wow. So it's public-private with some of the biggest names in AI. No wonder the market's so excited.
Right. It shows commitment to developing and using AI tech on a scale we haven't seen before. The benefits could be huge.
Absolutely. We're already seeing companies like Dell and Supermicro who make servers for AI experiencing stock surges. And of course, the AI leaders like Microsoft and NVIDIA are benefiting too. Everyone wants a piece of that AI pie.
It feels like a turning point. This investment could spark a wave of AI innovation. We could see breakthroughs in healthcare, transportation, finance, so many fields.
It's pretty incredible to think about. And speaking of big changes, NVIDIA has now surpassed Apple as the world's most valuable company by market cap.
What a shift in the tech world.
NVIDIA's strength in AI combined with Apple's recent stock decline has led to this.
It shows how quickly things can change in tech.
Yeah, and speaking of Apple, their stock decline was partly influenced by Jefferies downgrading their stock recommendation. So even the giants can stumble.
It's true. No company is immune to market forces and investor sentiment.
Okay, before we get too deep into tech, let's look at travel. United Airlines is having a good day. Their stock is up 5.5%. They're flying high on better-than-expected fourth-quarter results.
They reported adjusted earnings per share of $3.206 on revenue of $14.7 billion,
That's great.
beating analyst expectations. And their positive first-quarter earnings forecast is boosting investor confidence even more.
It seems people are ready to travel again.
The travel industry is showing signs of recovery, even with rising fuel costs and all the geopolitical stuff.
Now let's move on to consumer goods. Procter & Gamble is another company exceeding expectations today.
They reported earnings per share of $1.88, beating the expected $1.86.
Solid.
And their revenue increased by 2% to $21.88 billion, exceeding projections there too.
They're even sticking with their 2025 forecasts.
Yeah, predicting earnings per share between $6.91 and $7.05.
All right.
And revenue growth between 2% and 4%. Their stock is up 3.3% already.
So it's good news for the whole consumer goods sector.
Definitely. P&G's performance shows strong consumer demand and their ability to manage costs in a tricky economic environment.
Now, here's an interesting one, Johnson & Johnson. Their stock is actually down today, even though they beat market expectations.
I know, it's a bit of a head-scratcher. They reported adjusted earnings of $2.04 per share on revenue of $22.52 billion, surpassing analyst projections. But investors aren't biting.
So what's going on there? Why the decline?
It shows that there's more to stock performance than just hitting those immediate financial targets. Sometimes investors are looking at the bigger picture.
Like what?
Well, they could be considering long-term trends in the pharmaceutical industry, potential risks from lawsuits or regulatory changes, or even just the overall market sentiment affecting healthcare stocks.
So it's not always just about the numbers, it's the story behind them.
Exactly. And that's why it's so important to look beyond the headlines and really understand a company's fundamentals, their position in the industry, their long-term prospects.
All right, let's shift to the overall earnings performance of S&P 500 companies. Bankinter has some data on this.
They say that with 52 companies having reported their quarterly results, the average earnings per share increase is 7.9%.
Okay.
That's higher than the initial 7.5% projection, which is good.
Definitely. And get this, 86.5% of those companies are beating earnings expectations. Only 13.5% disappointed.
Pretty impressive. But it's worth comparing this to last quarter.
Okay, how does it compare?
In Q3 of 2024, earnings per share increased by 9.1% compared to an initial 5.1% projection.
So growth is a little lower this quarter,
Yeah.
but they're still exceeding projections.
And a lot of companies are beating expectations. It suggests they're navigating the economic landscape pretty well.
Right. Before we move on, let's wrap up with a quick look at oil prices and the U.S. dollar.
Okay, oil prices are pretty stable right now. Traders are keeping an eye on U.S. inventories, the impact of President Trump's tariff proposals, and his national energy emergency declaration.
Right.
A lot of factors at play.
So where are we at with oil prices right now?
Brent crude oil is trading at $79.11 a barrel, while West Texas Intermediate futures are at $75.67.
Okay. And the U.S. dollar?
It's near two-week lows, mainly due to that uncertainty around Trump's tariff plans. The market is really sensitive to any news about trade tensions escalating.
So how low are we talking?
The U.S. dollar index is down 0.1% to 108, just above that two-week low of 107.86 it hit yesterday. And the euro is trading at 1.0426 against the dollar. These currency swings really highlight how connected the global economy is.
For sure. What happens in one place affects everything.
Absolutely. It's a complex web of interconnected factors.
Yeah.
But that's what makes it so interesting to analyze.
It really is.
Yeah.
Well, we've covered a lot in this first part of our deep dive, from market trends and economic data to company performance and political uncertainty.
It's been a whirlwind.
But we're just getting started.
Yeah. It really is amazing how all these different pieces of information, from corporate earnings to global trade dynamics, come together to shape the market.
It's like a giant puzzle trying to see the big picture emerge from all the individual pieces. Speaking of those pieces, I wanted to go back to the impressive earnings performance of those S&P 500 companies.
Yeah.
That Bankinter data showing that 86.5% of them are exceeding expectations. That was a big one.
It really is a good sign about the overall health of corporate America. It seems like businesses are finding ways to adapt and succeed in this economic climate.
But I'm curious about how this quarter's performance stacks up against previous quarters. Is this level of success normal, or are we seeing something truly exceptional?
That's a great question. And the banking data actually gives us some good context. Last quarter, in Q3 of 2024, earnings per share increased by 9.1% compared to an initial projection of 5.1%.
So a slightly higher growth rate last quarter.
Right.
But consistently exceeding expectations is still a sign of strength, isn't it?
Absolutely. It points to a solid level of corporate profitability, which is essential for continued economic growth.
Right.
But we also have to remember that past performance doesn't guarantee future results.
True. The market's always changing, responding to so many factors. It's like trying to predict the weather.
Exactly. There are just too many variables at play.
So while this positive earnings trend is encouraging,
Yeah.
we can't forget about those potential problems on the horizon.
Things like rising interest rates, those ongoing geopolitical tensions, or even just unexpected events like natural disasters or global health crises. They could all have a big impact on businesses and the market.
It's like navigating a ship through uncharted waters. You have to constantly adjust course based on the changing conditions and those potential storms brewing out there.
Speaking of navigating uncharted waters, that brings us back to oil prices. As we mentioned earlier, they're relatively stable at the moment. But traders are watching several key factors that could really shift things.
Right. We talked about those U.S. inventories, President Trump's tariff proposals, and the ripple effects of that national energy emergency declaration. It's a lot to consider.
It is. And the way these factors interact is what makes the oil market so unpredictable and dynamic. For instance, that emergency declaration could potentially increase demand for U.S. oil as we push for energy independence.
But then those tariffs could disrupt global trade and affect oil prices in ways we can't even foresee.
It's a tough balancing act.
And the market is trying to figure out the long-term consequences of these policy decisions, weighing those potential risks and rewards.
Right.
And we can't forget about the U.S. dollar, which is definitely feeling the heat from all this uncertainty surrounding Trump's trade policies.
Yeah. The dollar's dip near those two-week lows suggests that investors are hesitant. They're waiting for more clarity on the trade front before making any major moves.
So the market's in wait-and-see mode, carefully watching how these trade policies play out and what they might mean for the global economy.
It's a good reminder that politics and economics are inseparable. Policy decisions made in Washington or anywhere else can ripple across global financial markets.
It's like a high-stakes game of chess where every move has the power to change the whole board.
Absolutely.
And speaking of changing the game, let's get back to AI and that massive $500 billion investment from President Trump.
That investment is a game changer. Not just for tech, but for pretty much every industry. The involvement of OpenAI and SoftBank in this joint venture Stargate is especially significant.
It's like assembling the dream team for the AI revolution. Bringing together the best minds in AI with that kind of financial backing is bound to shake things up.
It's a powerful combination. That investment could really speed up the development and use of AI tech across a wide range of industries. From healthcare and transportation to finance and manufacturing, the possibilities are endless.
It's amazing to think about all the potential, but with all this excitement, I also wonder about the potential challenges and ethical considerations that come with such rapid AI advancement.
That's a critical point. And it's one we need to think about carefully. As AI systems get more sophisticated and integrated into our lives, we have to address those concerns about bias, privacy, and responsible development.
We have to make sure AI benefits everyone, not just a select few. We don't want to worsen existing inequalities or create new ones.
Definitely. It's a complex and multifaceted issue that requires a thoughtful conversation and collaboration between policymakers, industry leaders, and society as a whole.
And speaking of complex issues and the need for careful thought, let's circle back to President Trump's trade policies, which have been a recurring theme in our analysis today.
For sure.
His statements about those potential tariffs on imports from Mexico, Canada, and China have injected a lot of uncertainty into global trade flows. Businesses rely on predictable trade flows, and any disruption can have significant consequences.
Absolutely.
And while the market seems to be interpreting his approach as more moderate than initially feared, the threat of those tariffs is still out there. It's a delicate situation.
It is. The situation is still evolving, and it's essential to keep a close eye on how things develop. The outcome of these trade negotiations could have a huge impact on global economic growth and market stability. If those tariffs are actually implemented, It could trigger retaliatory measures from other countries, potentially leading to a trade war.
That would be bad for everyone involved, disrupting global supply chains, increasing prices for consumers, and hindering economic growth.
Exactly. It's in everyone's best interest to find a solution that supports free and fair trade while addressing legitimate concerns about unfair trade practices and intellectual property protection. It's a complex challenge that requires careful negotiation and compromise.
Let's hope cooler heads prevail and we can avoid a trade war that would benefit no one. It's fascinating how this deep dive has uncovered so many interconnected threads, from corporate earnings to AI investments to the complexities of global trade.
It really shows how connected the global economy is and how events in one part of the world can ripple across borders and affect seemingly unrelated sectors. It's all connected in some way.
And as we try to make sense of all this information, it's so important to stay informed, think critically, and consider multiple perspectives. There's rarely a simple answer to these complex issues.
You're right. In a world of constant change and information overload, the ability to analyze, synthesize, and connect the dots is more valuable than ever.
You're absolutely right. And with that in mind, let's take a moment to reflect on everything we've talked about so far before we move on to the final part of our deep dive, where we'll wrap things up with a look at some interesting company performances and a thought-provoking question to leave you thinking. Okay, we're back for the last part of our market deep dive. And we've covered a lot of ground today, from those high-flying tech stocks to the wild world of oil prices. And of course, we dug into President Trump's policies and all that economic data. But before we finish up, I want to touch on a couple of company performances that really stood out to me. The contrast between companies like Johnson & Johnson exceeding expectations but still seeing their stock drop, and others like United Airlines just soaring on positive news.
It's interesting, isn't it? It shows that the market doesn't always react in a completely logical or predictable way to financial news.
Right.
Sometimes there are these underlying factors at play, like investor sentiment or long-term industry trends that can influence how the market responds, even to good news.
Yeah. It's a reminder that we need to look beyond just the headlines and dig a little deeper.
Absolutely.
Now, speaking of good news, Procter & Gamble, they seem to be killing it.
Yeah, they are.
Strong earnings per share beating those analyst projections. And their revenue growth was impressive too. What's even more encouraging is that they're sticking to their 2025 forecasts, projecting continued growth and profitability.
Right. It's not just a one-off.
Mm-hmm.
They're consistently exceeding expectations,
Yeah.
which is a really good sign for investors. Shows that their long-term strategy is working.
Yeah.
And that creates confidence and stability, especially in a market that can feel so unpredictable sometimes.
Definitely. And then there's United Airlines, riding high on those better-than-expected fourth-quarter results. And their strong first-quarter earnings forecast is also giving investors a reason to be optimistic. It seems like the demand for air travel is coming back, despite all the challenges out there.
It does. It's not just United. We're seeing positive signs across the travel industry, which points to a broader economic recovery and maybe even a growing sense of confidence among consumers. There's still some obstacles, of course, like those fluctuating fuel costs and all the geopolitical uncertainty. But this upward trend is definitely encouraging.
It feels like the market's betting on the future of travel. And right now, United Airlines is in a good spot.
Yeah, they are.
It makes me wonder what other sectors might be set for similar growth as the global economy keeps changing.
That's a great question. And it's one that investors are always trying to figure out. They analyze trends, assess risks, and look for opportunities. Trying to anticipate where that next wave of growth will come from. It's a dynamic process, and it's what makes the market so interesting to watch.
It really is. Well, I think we've covered just about everything in our market deep dive today. We looked at economic data, dissected company performance, analyzed President Trump's policies, and explored all those complex forces that shape the global financial landscape. It's been quite a ride.
It has. And I think the main takeaway here is that the market is a complex and interconnected system. It's constantly responding to all sorts of factors.
Right.
There are rarely easy answers or predictable outcomes. So it's crucial to stay informed, think critically, and consider all the different angles.
Exactly. And on that note, we want to leave you with one final thought to ponder. Throughout this deep dive, we've seen signs of a strong economy with strong corporate earnings and a positive market performance. But we've also seen those persistent uncertainties, especially around trade policies and geopolitical tensions. So here's a question. What does this mix of economic strength and political uncertainty mean for the long-term stability of the market?
That's a tough one.
Yeah.
And there's no easy answer. It's something that analysts and investors will continue to debate. But by staying informed, doing your research, and keeping an open mind, you can navigate the ups and downs of the market with more confidence and clarity.
Couldn't have said it better myself. Knowledge is power. especially in the world of finance. So until next time, keep learning, keep exploring, and keep diving deep.